what will happen to stocks and crypto markets as a result of the Fed rate hikes that will for sure continue well into next year. Here I find myself disagreeing with most people I've seen. Also, most people seem depressed here. I'm excited because as a trader and investor, this can open up fantastic possibilities for us. And if you're on our trend-based process, you've been very well positioned and can really take full advantage of this scenario now that it's developing. As a human, I do feel bad for everyone who will lose their jobs. But as a trader, I'm super excited. It's happening, guys. And I think it's important to separate those two. I'm a simple man, I like numbers and simple facts. And while I've been big boss, I've done big business deals, I'm not an economist. I'm a technology man, an engineer. And I always felt like if you can't explain something in simple terms, you haven't really understood it. And I feel the big picture now has gotten lost in too many details. Here's the stock market on the 5-minute chart.
Strongly committed to bringing inflation back down to our 2% goal.
And as usual, it's even more dramatic on the Bitcoin chart. Jerome Powell is using this word, then it pumps 1,000, then he's using that word, then it dumps 1,000, then he's using this word, then it pumps 1,000, then he's using that word, then it dumps 1,000. And then today it's pumping 1,000 again. Guys, get a grip on yourself and let's look at the big picture numbers instead. Here you can go in and download the actual presentation material. Let's look at the rates first. And then we'll go into what I think is the more interesting part of this. So each circle here is an individual participants of this meeting's judgment of the appropriate target range, or for the coming years, appropriate target levels at the end of the specified calendar year. The first thing we can note then is that they're in quite agreement for 2023, but then in quite disagreement for 2024 and 2025. And then in the long run, they're in agreement again what they want to 25 to 2.5% target rate. Now let's check if the markets agree that this will happen, or are they just blowing smoke screens? So if you check end of 2022, market thinks we'll land at 425 to 450. 425 to 450 is here. What about 2023 then? 450, 475, 450, 475 in September, 450, 475. Then towards the end of the year, market thinks it will drop a little bit, 425, 450, 425, 450. 425, 450 is here. 450, 475 is here. So yeah, 2022 and 2023, the markets do agree that this is what they will do. So this scenario here then over the next couple of years is what will happen then? Well, I'm not so sure. Let's look at what the same guys and girls said 1 year ago from the September 2021 meeting. I realize the text gets really small here, but I will walk you through it, so don't worry. On the left side, we see the target rates from September 2021. On the right side, we see the target rates from the meeting yesterday, September 2022. 0 is here on both charts, 4% is here on both charts. 2022, as you recall now, is between 4 and 4.5% among the participants. Last year, most participants said that it should be 0 to 0.25. The highest number was 0.5 to 0.75%. This is 2022. This is 2022, they're at the same height. This chart ends at 4%, 4% is here, and it goes up to 6% over here. Then last year, they did expect an increase in 2023. Most people thought a little above 1%. Now for 2023, we're talking 4.25% up to 5%. Then last year, in 2024, they thought target rate should increase more, maybe up to 2%. While now we're saying in 2024 it might drop, but drop to below 4%, while the longer term target is the same. But well, in the long run we're all dead, so the timing also matters. So the truth is that even the best economics experts in the world find it difficult to predict the future. And you think some guy on Twitter knows better? The mass market of people, they want to hear some oracle on Twitter, like Plan B, telling them that the markets will go up. Well, that doesn't work, guys. It's dangerous relying on something like this. It's been great for his business and social media growth, but his model has wrecked more people in 2022 than even the worst altcoin scams. And I said this already last year, the mistake he is doing is that he has taken data from 2010 to 2019 and then extrapolated that into a completely different economical environment in the end of 2021 and now in 2022. than we had in this period where the data came from. The data he's using for the regression isn't representative for the environment he's extrapolating it into. And then he doesn't update the linear regression with the new data. Of course you get unreliable results then. Don't rely on stuff like this for 2023. It's dangerous. I offered to have him on the show already last year, and I could have helped him improve the model, but he wasn't willing. I don't want to backtalk anyone without giving them a chance to respond, so the offer still stands. I think it could be a fun discussion. And this is the very reason that I prefer to follow the trend of what actually happens instead of trying to predict the future, because it turns out that's rather difficult. It's far more accurate to react instead, as you've seen if you've followed along here. If you haven't, now is the time to hit that subscribe button. Back to the Fed. So will this prediction happen? Color me skeptical that this scenario will play out with high confidence. Because look at these graphs. Change in real GDP. So real GDP means that it's adjusted for inflation. In dollar value it would increase for sure, right, if inflation is so high. So GDP dropped a lot in 2020 with the COVID, then it recovered in percent compared to the previous year. And now we're saying that it will be approximately flat for next year, little above zero. Then they're saying that the GDP will increase 2023. So how much is that? That is over 1%. Some think up to 1.5%. And then it will continue to increase in 2024, up to 2%. Then stay flat and healthy. Unemployment rate. When COVID hit 2020, it was up almost at 7%. Then it came back down to about the same level as before in 2021. And in 2022, it's a little below 4%. Then they're saying in 2023, it will only increase from about 4% up to what? 4.5%, something like that. And then in 2024, it will hold exactly the same. So almost the same as 2021 all the way until the longer run. And while 1.4 million jobs lost, of course, it's a huge tragedy in numbers. You see here in this chart, they just predict a small change, and some are more optimistic, saying it will barely affect at all. So nowhere near the big swings that we saw 2 years ago. Really? I went to a cafe this morning and bought a coffee. The owner there said that during the past 3 weeks there has been a dramatic drop in visitors. People are getting scared for what's happening with the economy. Maybe the first thing they do is to cut down on small expenses like fika, which is a great Swedish word for coffee and something to eat and socializing a little. People start worrying about real estate prices dropping. They start worrying about costs going up. They start worrying about losing their jobs. Then they will spend less. I'm guessing this will happen to a lot of sectors, not just the Swedish fika sector. Then combine that with costs increasing, for many reasons. Interest rates go up, meaning cost of capital increases. Electricity has gotten a lot more expensive, and that problem isn't going away. I made a whole video on why. Supply issues from China, because for some reason they're still having some weird policies over there. Inflation could drive up costs for your supply in your business faster than you can renegotiate contract prices with your customers, and so on and so forth. What happens then to a company if sales go down because people hold on to their money tighter instead of spending them at the same time as costs go up? What happens then to profits? Well, they can drop dramatically. Profits might go from plus 10% to 0 or to minus 10%. And in many cases, the whole company might go bankrupt. In best case, the earnings drop dramatically. And so there is no confusion. Earnings means the net income. It's the company's bottom line, meaning its profits. And the drop in the stock markets that we have seen so far is mainly a drop in the speculative multiplier. P/E ratio simply means how many times the earnings people are willing to pay. There are details to that, but we ignore that for the moment. Just look at the big picture. That ratio, for example, for S&P 500 has dropped quite a bit from a year ago. 21 versus 31, for Nasdaq 25 versus 36. The speculation has dropped. The numerator in the equation has dropped. But say that even in a very optimistic case, that this ratio holds constant going forward. If the denominator for the equation, the earnings, the E, starts dropping too, the price will drop too. And I think this is just starting now. This worry can be seen in flight to safety, which after all still remains the US dollar. DXY, the dollar currency index or the dollar strength index, still continues its parabola. The retracement today is small. This is not a break in the parabola. That would look something like this. And if we take, for example, my currency as an example to make this a little clearer to understand. Beginning of 2021, $1 cost 8 Swedish crowns. Right now it costs 11, and yesterday it peaked at 11.13. If we look at the monthly chart, it was 4 in the 1980s, and it has never ever, not even here in 2001, been that high. So right now people are running to safety, which is the US dollar. But the dollar is inflating away, right? So where will people put their money? Stock market is on the way down, real estate is on the way down. Gold. Gold should hold its value, right? Oh no, gold has dumped too during 2022. What's going on? Shouldn't this be the hedge against inflation? Well, the way that it works is that when one asset dumps in the emergency phase, all the assets will dump too. The reason is easy to understand. Say that it's an individual investor or a fund or something. When they lose money on the stocks, they need to sell something else, perhaps to cover the losses or to rebalance their portfolio. And then they will sell the gold too. Then price goes down. But I think there could be a recovery here after the patient is out of the emergency room. Gold is very close to this key support. Now, past couple of days it has fallen down below, and this is a really critical point. There's a long way down if this doesn't hold, but should it climb back, this could be very interesting, especially if we zoom out and this starts to look like a cup and handle or something like that. If that happens, could that spill over to Bitcoin as well as the digital gold once the emergency phase is over? I don't know, maybe, we'll have to see. It is not how the market is behaving right now, so let's take that when it actually happens. Right now for Bitcoin, the trend remains down and the chart is still at a very critical point. We're right at the neckline of a head and shoulders. Left shoulder, head, right shoulder, but it hasn't broken down yet. This neckline has not broken yet. Instead, today we're getting a bounce just off the neckline, clearly because DXY has a rejection here. I will maintain a reactive mindset. The Fed doesn't know what will happen. Your favorite Twitter guy doesn't know. You don't know. I don't know. The only fact we have right now for this market, Bitcoin specifically, is that Large Online remains down from the 49,000 level, and we're very close to completing a head and shoulders with target. This height downwards would take us somewhere down here if it confirms, but this pattern has not confirmed and meaning completed yet. Stock markets are looking challenging. DXY is continuing its parabola, still intact. Gold is threatening to break a key support, but if it holds, this could get very interesting too. Smash the subscribe. We're crushing it, guys. I'm working on expanding this community. Tomorrow, another step on that. Thank you, tack. CTO Larsen out. Hej då!